Welcome back to Week in Review. The market spent most of this week red. Bitcoin sliding from the high 70s into the mid-70s, Ethereum giving back what little ground it had reclaimed, and sentiment locked in extreme fear. But underneath the surface red, the week told a remarkably consistent story, one we set up earlier in our Macro Meets Crypto opener. The institutional bid in crypto is reshuffling. And this week, the data made it harder to argue with. Let's start with the protocol that quietly dominated the week. Hyperliquid. The week before, Bitwise's spot Hype ETF launched on the New York Stock Exchange under ticker BHYP, the first US-listed Hyperliquid ETF with in-house staking. The day before that, Coinbase took on the official Treasury deployer role for USDC on Hyperliquid, with USDC supply on the network already at around $5 billion. Then this Thursday, the Hype token gained 20% in a single session, while almost everything else was bleeding. By the end of that day, Hyperliquid had flipped Solana by fully diluted valuation, around $54 billion. And on Friday, even as the broader market continued lower, Hyperliquid kept drawing inflows. None of these announcements happened in isolation. Together they say something specific. When institutional capital is rotating out of generic crypto exposure, this is what it's rotating into. Speaking of that rotation, spot Bitcoin ETFs continued bleeding this week. $649 million out on Monday alone, on top of the prior week's nearly $1 billion. Spot Ethereum ETFs extended their outflow streak to the longest run of this cycle. But Solana and Hyperliquid products drew inflows at the same time. The institutional dollar isn't going home. It's choosing more specific exposure. Ethereum had a particularly rough stretch. Beyond the ETF outflows, sentiment cratered on the back of a brain-drain narrative that's been building for weeks, with multiple high-profile holders unwinding positions. Harvard's endowment offloaded roughly $87 million of Ether on Thursday. The community is openly calling it an identity crisis. Ether is still the second largest crypto asset, and the network's user base remains massive. But the institutional position on Ethereum is genuinely weaker than it was a month ago. Meanwhile, the operational side of DeFi had another reminder of its weakest layer. On Friday morning, on-chain investigator ZachXBT flagged a suspected exploit on Polymarket, the world's largest decentralized prediction market. The attacker drained roughly $600,000 from a contract that handles reward payouts on the Polygon network. Polymarket's core market resolution contracts and user funds weren't affected. The cause? A compromised private key on an internal operations wallet. If that sounds familiar, it should. We covered exactly this failure pattern in our Mayhem recap on Tuesday. Echo Protocol. Thorchain. Now Polymarket. Different platforms, same boring failure mode. Even as crypto's institutional shape gets more sophisticated, its operational hygiene keeps lagging behind. On the regulatory side, the week's biggest expected story didn't quite land. The SEC's so-called innovation exemption, a framework that would let crypto-native platforms offer tokenized US stocks under lighter rules, was widely reported Monday as expected within days. By Friday, the timing had been pushed back. Stock exchange officials and former regulators raised serious concerns about third-party tokens issued without company consent, dividend and voting rights on pseudonymous blockchains, and the risk of stolen or sanctioned tokens proliferating overseas. The framework isn't dead. Commissioner Hester Pierce signaled this week that an exemption is still expected, just limited in scope. For now, the tokenized-stock conversation is bigger than the rule that would unlock it, with the market itself up roughly 30% over the past month to around $1.4 billion. We covered the full picture in our explainer on real-world assets yesterday. A few macro and corporate threads worth flagging. The aftershocks of Strategy's softening of its never-sell stance kept moving the corporate-treasury conversation. Mark Cuban announced he sold most of his personal Bitcoin position this week, saying it had failed as a hedge during recent geopolitical strain. SpaceX revealed in an IPO filing that it holds around $1.4 billion of Bitcoin. And on Wednesday, President Trump signed an executive order telling U.S. agencies to update regulations to integrate crypto into traditional payments and financial systems. Each of those threads is different. The combined picture is the same one we've been tracking. Even as price action stays soft, the structural integration of crypto with traditional finance keeps accelerating. Pull all of it together and one story keeps showing up. The institutional position in crypto is reshuffling out of Bitcoin and Ethereum ETFs into more specific protocols, out of pure buy and hold treasury doctrine into something more tax-aware and flexible, out of generic crypto as hedge framing into something more like crypto as infrastructure. The market spent this week red. The infrastructure didn't. Looking ahead, next week is a US holiday shortened one. Monday is Memorial Day, so news flow will likely be lighter. The big calendar item is Friday, May 29th, when about $6 billion of Bitcoin options expire, with traders positioning heavily toward the $80,000 call side. The SEC's innovation exemption, now delayed, could still surface in the coming weeks. We'll have it covered. That's the week. We cover crypto on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.